In this video, we are going to compare two famous international ETF listed in ASX. The first one is Betashares Nasdaq 100 with the ticker code NDQ, and the next one is BlackRock iShares Global 100 ETF with the ticker code IOO. Both of the ETF can be accessed through ComSec Pocket. They put a different nicknames for each ETFs. For example, Nasdaq 100 is also called Tech Savvy. Before we carry on, I just want to make sure you understand that this is not a financial advice. This video is informational and for educational purpose only. And I'm not saying you should buy ComSec or sell this ETF or skip investing in this ETF. It's purely informational. Let's start with a 5-year comparison of the unit price for these two ETFs. You can see the yellow line is for the Nasdaq 100 and the blue chart is for the Global 100 ETF. And it looks like NDQ is outperforming IOO. And we're gonna get into the holdings, the underlying companies that this ETF are investing in, and I will explain to you that it is quite difficult to predict its future. So BlackRock iShares IOO has the management fee about 0.4% per year, and they follow the index provided by S&P, Standard & Poor's, and the index is called S&P Global 100. And in 2018, BlackRock's converted this ETF to be Australian domiciled, which gives more convenience for Australian investors. The Global 100 ETF has been around since December 2000, so it's been a while, almost 22 years. And if we look at the annualized return for IOO, it's pretty amazing. For example, they did 15% per year for 10 years. But again, this is another reflection that past performance doesn't repeat itself. That if you look at the return since inception, the annualized return is much lower compared to 15. It's like around 3.8% per year. You can check out the growth potential of $10,000 and as you can see, since inception around the year 2000 till 2011, the index is not doing so well. Which proven again the stuff that we said that past performance doesn't repeat itself. But since the year 2011, the ETF has been going up and they're not showing a sign of slowing down. Even the COVID pandemic didn't stop it. Now, Betashares Nasdaq 100 with the ticker code NDQ. He has a management fee slightly higher, around 0.45% per year, and the fund has started a bit later compared to IOO since 2015. And they followed the index Nasdaq 100. So the companies they're investing in most likely will be listed in Nasdaq. Therefore, most of them will be US based as opposed to IOO where you have diversification across different countries. And I think there are Australian names as well, such as BHP. In terms of performance, Betashares NDQ also has achieved double-digit return. And I like the little description that ComSec Pocket mentioned about each ETF. I'm not endorsing ComSec Pocket for you at all. I like how they explain Global 100 to be an ETF that give you exposure to the global blue chip companies and best well-known brands, whereas Nasdaq 100 NDQ is more technological, innovation type companies. So this is the top 30 holdings of BlackRock's IOO. And although the ETF say it's a Global 100, the ETF actually has 105 holdings of company shares. And as you can see on the top 30, they have diversification from US-based companies. There are Korean names such as Samsung. There are Australian names like BHP and French luxury brands such as Louis Vuitton. Top 30, they constitute about 75% of the total portfolio. So the rest of 75 companies, they just make up to 25% of the portfolio weightings. You don't have to be a genius by just looking at these top 30 companies. There are great brands such as Samsung with this Galaxy phone, G Note, whatever, and Apple and Google with YouTube, even Nike as well. They are great brands that is very difficult to replicate. When something is difficult to replicate, usually they have a competitive advantage, and some value investors call it an enduring moat. So you can be comfortable that for the next 10, 20 years, they still be around. But from what I learned so far, great business, great brands doesn't always mean great investment, because sometimes people can overvalue these great brands and the result of that return will be mediocre. But again, since these two ETF are index-based investment, so you're putting all of your trust in this index and the rules within the index. This video is just giving you a head start by showing you, oh, this is the holdings base of September 2022. It may change in the future, but if you're happy with it, you can do more research yourself. Now with Betashares NDQ, Nasdaq 100, they say it's a Nasdaq 100, but they have actually 102 companies within the ETF. And it's similar to global IOO, that the top 30 companies constitute about 75% of the portfolio. It's more than just tech savvy. Like the companies within this ETF also have great brands. They have enduring moats. If you look at the rest of the holdings, they have global chip manufacturers and they have huge market shares such as Micron Technology. I think what Comsec Pocket description saying that there's non-financial, meaning that this ETF doesn't invest in banks, but there are financial technology companies within this NDQ such as PayPal. It's pretty difficult to have an understanding for all of these hundreds of great brands, great companies. But if you are interested to learn more, I would recommend Nick Sleep letters from Nomad Capital Partnership. He explained about Costco business model, and I think it's pretty good. Give anyone a head start in how to view investment. And before I get to the last point of this presentation, is that the world has changed. The businesses have what I called a lot of asset that is intangible. It's more than just a property, a manufacturing plant, how many computers or employees that you have. The intangible asset is often very difficult to evaluate using the current accounting standard. For example, in Betashares NDQ, Meta platform, used to be called Facebook. How do you evaluate the value of Facebook? It's pretty difficult. How do you evaluate the future cash flow for Instagram? And how Facebook spend at least 20 billions a year in research and development, and how it will affect its future cash flow. It's pretty difficult. And again, it comes back to my previous point that past performance doesn't repeat in the future. And also, you gotta be really happy with this to index and the rules around the index. So you have to do more research about how the index is constructed yourself. What's interesting is that both of the ETF, NDQ and IOO, they invest in this same company. So I call it great minds think alike. It seems like they are very optimistic with the future prospect for Apple, Amazon, Google, Alphabet, Microsoft, PepsiCo, and Intel.